So you just hit the second decade of your life. Congratulations. Your 20s are going to be filled with many great experiences. You're legally able to drink at 21. You can throw your fake ID away when you're trying to enter the club. Probably finishing up college, moving out of your parents' house, starting your career, enjoying the peak years of your life physically. Maybe even getting married and starting a family in this decade. Your 20s are going to be filled with a lot of adventure. Some of the best memories of your life are going to be made in this new decade. But one of the perks of being this brand new adult is the new decisions you have to make in regards to your future and how your actions now can impact your life later. Now, one of those big decisions is investing. Just to clarify, this won't be an in-depth video on investing, but rather tips to keep in mind no matter what investing journey you decide to take. I do, however, have a video discussing the 5 asset classes of investing linked below, so be sure to give that a look. Without wasting any more time, you tuned into the Joy Network where just owning you is your responsibility, and let's dive into the 5 investing mistakes you want to avoid in your 20s. Disclaimer, this video is intended for educational and entertaining purposes only. Anything that I say in this video is not financial advice. Please do your own research in regards to any investments you decide to undergo. Kicking off this list will be, well, not kicking it off. What I mean is your first mistake is not investing. This is a simple but dangerous thing not to do. When you are young, you have the biggest advantage, time. You quite literally have time on your side. The thing that makes investing at an earlier age awesome is called compound interest. You ever heard of this dude named Albert Einstein? He's just a tad bit famous. You might have also seen the formula of his passed around. Well, this guy had something to say about compound interest. And here's what he had to say. Compound interest is the 8th wonder of the world. He who understands it, earns it. He who doesn't, pays it. So quotes and new terms put aside, what is this 8th wonder of the world? Compound interest is the addition of interest to the principal sum of a loan or deposit, or in other words, interest on interest. It is the result of reinvesting interest rather than paying it out, so that interest in the next period is then earned on the principal sum plus previously accumulated interest. As an example, if you have $10 and earn 10% interest, you earned $1 in profit. But instead of taking that money out, you don't touch it, and you allow your original investment and earned interest to earn another 10%. So the interest on $11 is $1.10, resulting in a total of $12.10. Then another 10% interest of that is $1.11, giving you a total of $13.31. And that process keeps repeating over and over and over again. Your earned interest also keeps getting higher and higher. Say we have 3 guys, Bob, Bill, and Tim. Bob is your normal 35-year-old gentleman. Works hard, saves his money every month, and puts it in his mattress. Bob's been saving for 30 years now, and saved $100 every month that whole time. At the end of that time, he's accumulated $36,000. Now that may seem like big money to some, but over the course of 30 years, that just isn't impressive. Let's move over to Bill. Bill loves his Benjamins. He's a 35-year-old who has recently discovered investing. He wants to jump in the game and start having his money work for him. He puts his money into this magical thing called the stock market. He doesn't want to spend a huge amount of time researching company fundamentals, so he decides to take the advice of a small-time investor nicknamed the Oracle of Omaha, Warren Buffett, who has a net worth in excess of $70 billion, and recommends that the majority of people would be better off placing their money in an S&P 500 index fund versus picking their own stocks. Historically, the S&P 500 index has returned 7% annually when adjusted for inflation. He decides to put in $100 every month, same as Bob. Now, using this wizard-like calculator, we can figure out how much Bill will have after investing for the same length that Bob saved. Bill is 65 now and has accumulated over $121,000. That is over 3 times more than Bob. Not bad, Bill. Now, let's move over to Tim, and I bet you saw this coming. Tim is the poster child of a 20-something-year-old investing his money in for the long run. The guy everyone is jealous of. Tim is the cool guy. You want to be him. You want to be Tim. He has the same investing strategy that Bill had. The only difference is Tim is 21. So when he is 65, like Bill, he would have had about a good 14 extra years on top of Bill. That equals over $350,000, about 2.8 times more than Bill, almost 10 times Bob, investing the same $100 a month from 21 to 65. That is the danger of not investing in your 20s. The missed opportunity of taking advantage of compound interest, and this example only used $100. Now, $100, let's be honest, isn't a lot. And if you say it is, I reckon you probably don't spend that in a weekend eating out, buying games, or spending on miscellaneous things that you really don't need. Imagine how much you would accumulate with $200 or $300. I'll give you those numbers right here. Second, you aren't taking enough risk. That's right, you're leaving potential growth and money on the table because you're playing it safe. You're in your 20s, you're young. That comes with a couple of advantages beyond the compound interest you mentioned earlier and all the booze you can drink at parties. Because you're younger, you have time on your side, which means risks that you take but may not go as planned allow you much more time to bounce back. Not to mention, most 20-something-year-olds don't tend to have as many responsibilities until they hit their 30s or 40s. You're probably still living at home, or maybe living with a roomie, which helps with your financial obligations. You might not have any kids. And by the way, none of those are knocks against you. Use them to your advantage. Less obligations outside of yourself can allow you to start investing heavily when you're younger and slowing down while simultaneously reaping those benefits as you get older. Also, if you're in your 20s but have kids or live on your own or find yourself not having the advantages I mentioned earlier, don't worry. You still have the most important one, time. Don't let your responsibilities impede you. Be happy that you started being responsible at a younger age. You will probably be more appreciative of the opportunities and the progress you made. Keep on investing. Don't make the mistake of not investing that we mentioned earlier. Investing is a game that few participate in. Taxes are a rule even fewer learn about. And this is the third mistake you should avoid in your 20s. Not taking advantage of tax advantage accounts. I'm not going to lecture anyone here about taxes and all the ways you can legally reduce your obligations to pay them. Those questions are best left to your CPA. They can legally advise you. I cannot. I can, however, explain two of the most popular tax advantage accounts that you can use: traditional IRAs and Roth IRAs. For your own information, IRA stands for Individual Retirement Accounts. Both perform the same functions as they hold your investments, stocks, bonds, cash, etc. But there are differences between the two. And I'm going to break those differences up in these little bite-sized pieces that you can easily digest. Starting off with taxes. A Roth IRA grows tax-free, meaning you don't pay any taxes on the money you withdraw. A traditional account grows tax-deferred, meaning you don't pay taxes until you withdraw the money. Contributions. You can contribute $6,000 of after-tax dollars a year to a Roth. What that means is you pay taxes on the money you contribute first. You can contribute $6,000 of pre-tax dollars annually to a traditional account. That means you contribute money to your account before taxes get pulled out of it. Income limits. Income limits essentially define who can contribute based off how much money they make. Roth IRA has an income limit of $139,000 for a single and $206,000 for a married couple. A traditional IRA does not impose income limits to who can contribute. Age restriction. Anyone can contribute to a Roth IRA as long as you're still earning income. Traditional IRAs have a cutoff at 70 and a half years old. Withdrawals. Roth IRA allows you to withdraw your contribution and earnings after 5 years and over the age of 59 and a half without incurring penalties and taxes. Traditional IRAs will allow you to pull your money out after 59 and a half penalty free, but you will pay taxes based on your current tax bracket. Whether you decide to go traditional or Roth, know that educating yourself on these tax advantage accounts can benefit you in the long term, while allowing you to keep more of your hard-earned cash in your pocket and not in Uncle Sam's. Did you know if you bought Amazon on May 16, 1997 with $1,000, it would be worth over $1.7 million today? Talk about great timing, right? The person who bought it at that time must have been a genius. Or maybe just stupid lucky. Let me give you some context. May 16, 1997 was about 8,431 trading days ago from the time of me recording this, which means if you were strictly looking at only Amazon, your chances were 1 out of 8,431 days to get that awesome investment opportunity. Now, more realistically, you probably weren't focusing on just Amazon. You were probably watching a multitude of other companies. If you watched 2, then your chances were 1 out of 16,862. What about 3? 1 out of 25,293. Now, just for simplicity's sake, the S&P 500 measures the largest 500 companies by market cap in the United States since 1957. By the way, Amazon wasn't added till 2005, but just using the S&P 500 index as an example of how many options you had to choose from in the stock market to invest, that number of 8,431 just jumped to 1 out of every 4,215,500. Oh, did I mention that there are literally thousands of publicly traded companies that you could have picked from? Those numbers aren't so convincing, are they? So, were you genius because you bought at that time, or were you just lucky? This brings me to the 4th mistake people make in their 20s. They try to time the market, always trying to buy the bottom and sell the top. Now, don't get me wrong, that would be nice. If you knew when the price of something was going to be at its absolute lowest and when it was going to be at its absolute highest, that would be sweet. But that isn't realistic. No more than you saying you know exactly what the winning numbers to the lottery are. You can make your best guess, but you aren't going to know exactly what those numbers are going to be. So if you can't time the market, what should you do? Well, there is a method called the dollar cost averaging. So let's say you have $12,000 to invest, but you don't want to invest the entire lump sum at once. Instead, you want to invest it over a 12-month period at $1,000 a month. So after investing all $12,000 over the course of that year, you find out that your average buy-in price is $50.83. You now have a total of $14,164.29. Your profit is a nice $2,164.29. So over the course of that year, you actually returned 18%. Not bad. Now, obviously, if you had bought everything at month 4, your returns would be pretty sweet. But again, you can't tell the future, and if you could, hedge funds will be knocking at your door offering you millions of dollars to manage their funds. This method is less risky, where you're not blowing your entire shot at one target and hoping for the best. Now, the last mistake you can avoid, copying someone else's investments. This is not only lazy, but dangerous. Lazy because you're allowing someone else the right to control your finances, letting their opinion impact your investment decisions. You are not forming your own investment decisions and opinion, you're just piggybacking off of someone else's work and research. By the way, that quote-unquote work and research they did might have been just advice that they got off of a blog or some online forum where someone told them to buy this stock or cryptocurrency because it is going to the moon. Remember, this is your money you're investing, which means you need to respect the process and put in the time to do your own research. I mentioned Warren Buffett before, recommended most people to buy the S&P 500 index fund, but that doesn't mean you should just drop everything and go do that. Even an investor like Warren Buffett isn't infallible. He can make mistakes too. And examples that I mentioned earlier about Tim and Bill putting their money into an index fund was only just an example, not a recommendation. If you find specific investments that intrigue you, sit down and do your homework and see if it's something you understand and are comfortable with. At the end of the day, there are a lot of people who are constantly throwing their money at quote-unquote investments, but really don't take the time to understand what they're investing in, why they're investing in it, and how they actually work. And that is something a 20-year-old should be doing. You are in the best possible scenario to really plan out your investments. Your risk tolerance is higher, your time horizons are longer, your recovery scenarios are more manageable. Not to mention, you have access to the most insane amount of information in the world, and that's called the internet, which has all the information you need to do research on any investment that intrigues you. If you avoid these mistakes in your 20s, you will be ahead of the majority of people in your generation. Heck, even people in the last generation. Remember, the biggest risk you can take is not taking any risk at all. If you enjoy what we do here, please leave a like, subscribe, and hit the bell to get notified when we release new content. Also be sure to check out the links in the description, not to mention the other videos we'll have somewhere on the screen. Thanks for watching.